In today's video, we are talking about the head and shoulders pattern. So by the time you finish watching this video, you're going to know what a head and shoulders pattern is, also the inverse head and shoulders, how to trade both of them. And also by the end of this video, I'm going to share some bonus content, some strategies for what to do when these patterns fail. And I can tell you right now, if you're just walking away from a failed head and shoulders and getting frustrated and leaving it and moving on, you are leaving a lot of profit on the table. So I'm going to have all the details at the end of this video. So looking at this chart here, let's talk about this, step by step, going through the different components of the head and shoulders. If you're familiar with the head and shoulders, feel free to, jump ahead. But I really encourage you to watch this because there are going to be details in here that not a lot of people talk about. So looking at this head and shoulders here, I want to talk about some imperfect head and shoulders patterns, not just your textbook stuff where you get one left shoulder, one right shoulder, and everything is lined up perfectly. Because the truth is that in most cases, that is not going to happen. In most cases, you're going to see messy patterns out there. And in my experience, the messy patterns actually tend to be a little bit more reliable for whatever reason than those textbook patterns. So a head and shoulders pattern, guys, is a bearish reversal pattern where you have the left shoulder over here. Okay. And just like the name implies, it looks like a head and shoulders, right? You get a left shoulder, a head, and a right shoulder and a neckline. So looking at this here, we've got the right shoulder over here. Now, I could technically make the case that there are two right shoulders. Now, again, this goes back to, let's look at some imperfect examples out there, right? Because real life is not always going to be textbook. And in most cases, that is not the way the market works, okay? So looking down here at these lows, this through here would be your neckline, okay? So again, it's a head and shoulders. You get the left shoulder, the head, the right shoulder, and the neckline. All right, so this is your neckline support down here. Now, this is a bearish reversal pattern where it essentially shows you that buyers are fatiguing. So by this point over here, by the left shoulder, we don't really know that the market's fatiguing because this just looks like a swing high, right? And that's especially true when you see this head up here because this is a higher high. So at this point, there is no sign of a reversal. It's not until this right shoulder over here that we start to, get an idea of what's taking place here. Because you get the market coming down here, repeatedly testing this level here and failing to carve another higher high. Instead, you get these lower highs that form. Now, again, this goes back to this imperfect head and shoulders pattern. And this goes for any pattern out there, guys. It's not always going to be textbook. So you could make the case that this is also a right shoulder. And that's okay. A head and shoulders pattern can have multiple left shoulders and multiple right shoulders or even multiple heads. There are a couple of things, though, that have to be in place here to call this a valid head and shoulders. The first one is that the shoulders cannot be higher than the head, okay? And in this case, you can see that even though we have these multiple shoulders over here, that all of this is below this, okay, this high. So that's valid, right? Now, the second thing that needs to occur, and this is something I see nobody talking about, is that these shoulders over here need to occur on, at least for the most part, the same horizontal plane. And if that sounds confusing, what I mean by that is this rectangle right here is our horizontal plane, right? You can see that this is our left shoulder over here. This is the price action for that left shoulder. And this is our first right shoulder, second right shoulder over here. Notice how all of this occurs for the most part on the same horizontal plane. Now, this right shoulder is a little bit higher than the left shoulder, and that's okay. Again, they are imperfect, okay? But for the most part, they are on the same horizontal plane, and that's what we want to look for. A lot of times, you'll see traders pointing out a head and shoulders pattern that looks like this, okay? And that is technically not a head and shoulders because if you draw a level across here, right, on that first left shoulder, what you'll notice is that this right shoulder over here is not on this same plane. It's not on the plane of the left shoulder, okay? So that would not be a head and shoulders. It would be more of like a trend line breakdown, right? So I do want to point that out because, again, I don't see a lot of people talking about this, but, technically speaking, these shoulders have to be, for the most part, on that same horizontal plane. So this is a good way to check it. Just draw a rectangle and notice if the shoulders are, for the most part, overlapping each other. Now, before we get into how to trade the head and shoulders pattern, let's talk about the neckline. Because this is another thing that trips up traders where, they're asking, can the neckline be sloped? And yes, it can be horizontal, it can be ascending, okay? And it can also be technically descending. Now, the one thing I will caution you about, though, with a descending neckline is that in my experience, and that's over 10 years of trading, a lot of times when you get a head and shoulders pattern that forms like this, right? The issue here is that, yes, this could be technically a valid head and shoulders. And if the market does break down and respects this, that's a very, very weak trend. But the issue here, the challenge, is that when you get a market that starts doing this, okay, the issue is that, as you can see, you can probably point this out already, this could be a falling wedge, which is a bullish pattern. So that's what you have to be careful of here with a descending neckline. This can turn into easily a falling wedge where you get the market actually breaking out to the upside, okay? So that's the one thing I will caution you about with that descending level. Now, if you're using an ascending level like this, again, that rule of the left shoulders having to be on the same horizontal plane is all the more important because you have a market that's essentially still in an uptrend, okay? So let's take a look now at an inverse head and shoulders before we talk about how to trade them because, for all intents and purposes, the inverse head and shoulders is essentially just an upside down head and shoulders. So as you might expect, this is a bullish pattern. Now, this is also a little bit different, right? Because looking at this chart, you can see where this is not at the exact bottom. However, technically speaking, this is still an inverse head and shoulders. We have the left shoulder over here. In fact, two, we have the head over here and we have the right shoulder. So this still meets all of the rules, right? We have both shoulders on that same horizontal plane. We have the head extending beyond those left shoulders. And we also have a descending neckline, which is valid, right? So everything checks out here. And you can see where this, played out really well, right? We got a nice breakout and nice move to the upside, even though this is not a perfect looking inverse head and shoulders. And again, it goes back to this is real life, guys. You're not going to find, those perfect patterns very often. And in my experience, for whatever reason, I can't tell you why, but a lot of times these imperfect patterns like this here, where you get, two left shoulders, one right shoulder, you get this chop through here. For whatever reason, when you find patterns like this that are technically imperfect, they tend to actually play out better than the ones that are textbook. Don't ask me why. I have honestly no idea why, but they do tend to play out a little bit better. So don't dismiss patterns that aren't perfect. As long as they follow the rules, then you're good to go. Okay, so now let's talk about what confirms this pattern. Taking a look at another example. Again, this is all about showing you guys different looks of the head and shoulders because they're not always going to be the same. So looking at this here, this is also technically a valid head and shoulders, right? You can see the left shoulder is quite a bit higher than the right shoulder, but still valid because they occupy the same horizontal plane for the most part, right? So we have the head above the shoulders. We have the same horizontal plane for the shoulders. We're good to go there. We have this ascending neckline. Now, in order to confirm a head and shoulders, okay, all of this over here, this is very important. All of this over here is technically not a confirmed head and shoulders pattern yet. We don't have confirmation until the market actually closes below on this candle here. So this is what confirms it. Now, a lot of traders make the mistake of thinking as the market is breaking down, this is what confirms it. In my experience, guys, the best way to confirm these patterns is to wait for a close or even multiple closes below that neckline. Okay, and obviously in the case of an inverse head and shoulders, the opposite would be true. You'd want to see that candle or multiple candles closing above the neckline. So this is what confirms it over here, right? We've got the confirmation on this candle. Now, let's talk about entry methods. There are two entry methods. The first one is to enter on the break, right? You enter as soon as the market closes down here. Now, obviously, there are drawbacks to this. The drawback is that if you're getting in down here and your stop loss is up here in this area, that's a really wide stop loss, right? You have to have an incredible target here for this to be a 3-to-1 reward to risk or better. So that's the drawback. The pro of getting in down here, right? We talked about the cons. The pro of getting in down here is that you don't always get a retest of the level, right? If we go back here to our first example, this over here is our neckline. And what you'll notice is if I zoom out, the market never tested this, right? The market took off to the downside and never tested it. So that is one benefit to getting in on the break. Like in this case, if you were selling it through here, right, you never got a retest up here. So anybody waiting for a retest would have missed out on this. And that's just a decision that you're going to have to make, right? There's no universal rule here that's better than the other. It's just pros and cons. So going back here to our other example, in this case, you can see that we did get a retest. So this is why, I personally prefer looking for the retest. Okay, so entry method 1 is going to be to enter on the break. Entry method 2 is to wait for the retest. Now, in real life, as this was unfolding, it would have been this candle right here, right? This price action through here that would have got me in. Now, my stop loss in this case, and again, this is where a lot of traders get themselves in trouble because they try to get in with a really tight stop loss to get that, better risk reward ratio. The issue with that is twofold. First of all, you're going to have a lot of stop outs. You're going to have a lot of cases where the market stops you out and then eventually goes in your favor. And the other issue with that is that it kind of flies in the face of what a stop loss is supposed to do, right? A stop loss has two primary jobs. The first one is to protect your capital. The other one is to tell you if a pattern is no longer valid. So let's take a look here at this. Let's say that you got in down here and your stop loss went above this candle, or even above this one for that matter. If you're putting your stop loss up here in this area, you have to ask yourself, if the market hits this, does that indicate that this head and shoulders pattern is invalid? And if you answer no, you're right. Because if the market came up here and took you out and hit your stop loss, this is right at the neckline, right? There's nothing about that that makes this invalid. So that's the issue with placing a stop loss really tight, because again, your stop loss has to, one, protect your capital, and two, it has to tell you if a pattern is invalid. And in this case, a stop loss anywhere in this area wouldn't do that. So really, ideally, you have to place your stop loss either above this high or somewhere at least up here in this area, right? I would say in the upper half of this candle. And you can see if you did that, this would have been safe, right? Even from this wick. So your stop loss has to go up here in this area, and it's going to vary, right? There's no one set rule for this because every pattern is going to be a little bit different. But the general idea though is that your stop loss has to go far enough, above this breakdown so that, if it's hit, it's telling you that this pattern is no longer valid. All right, so we have our confirmed breakdown here, confirmed here. We have our entry through here. We have our stop loss up here. Now, as this was unfolding, if I saw this candle, I would probably move my stop loss down. I would probably move it up here above this high, because I know at that point that if the market's coming up here in this area, that there's a good chance that this pattern's failing. Okay, so you could technically move it down here either as soon as you got in or, shortly thereafter. All right, so now let's talk about how to place targets. So in this case here, and here's one thing I want to show you guys too, talking about imperfect patterns, right? There's this notion that a head and shoulders pattern has to occur at the very high of a trend, okay? Meaning that the market has to trend higher for weeks or months, and then you get a head and shoulders pattern at the very top. And that's simply not true, because if you'll notice, this is actually within the trend, okay? So it used to be, and years ago I thought the same thing, that a head and shoulders pattern had to occur at the very high. But again, it's very rare that you're going to get this perfect head and shoulders pattern at the very high of a trend. A lot of times you get situations like this where it's actually within the trend, okay? But it's still just as valid because again, it shows exhaustion from the market. It shows exhaustion from buyers, or in the case of an inverse head and shoulders, exhaustion from sellers. Okay, so now let's talk about how to set targets. So in this case, again, talking about real life, let's just be real about this. If I were trading this pattern, because it would be great to look back on this and say, hey, if I was trading this pattern, I would use the measured objective and, take profit all the way down here, right? And life would be great. But in real life, you can see that we have these lows over here, okay? So this is why I always set multiple take profits, because yes, you have the measured objective of a head and shoulders pattern, which we'll talk about here in a minute, but you also have areas like this down here, right? You've got these highs over here. And so this is why, in my opinion, in my experience, it's better to have multiple targets. Okay, so let's run through this here. We've got these lows down here that would be my first target, right through here. You can see we did get a little bounce through here. So this over here would be target number one. Now, my second target, or third target, or however many targets you have, I tend to have at least 2 or 3 in there. Now, the measured objective, okay, let's talk about that for a second, because a head and shoulders pattern has what's called a measured objective, and that is essentially your target following the breakdown. And the way we get that is, and here's a little trick for you. If you're in TradingView, go to your settings down here and go to regular, which is actually a linear view. And there's a really easy way to come up with this, right? If you're not going to use a tool for it, you can take from the high up here down here to the neckline. Now I'm drawing this off the side a little bit so you can see where the high is here on this candle. So essentially this is our height. Now you take this and you're going to copy it over and drag this lower from the breakdown point. Now this is very important. I'm not dragging it from here. Okay, I'm not dragging it from here. I'm dragging from where the market broke down. So from that neckline, you've got the height up here, from the top of the head down to the neckline, and then from here at this breakout point, down here to a lower point in the market. So this would be the measured objective, right? So if we take this now, and let's just drag a horizontal ray over here, and I'm going to snap it right to this, trying to get it more, accurate here for you guys. So this over here, let's just recap. This over here is going to be our measured objective, right? Again, this is just the height of the pattern itself. So if we measure from the breakdown point, this is our objective down here, which you can see was hit. And we've got our first target over here. Okay, so entry method up here on the retest, the stop loss goes up here. You could trail it down here on this candle. You've got your first target down here at these lows. And then you've got that measured objective down here. So this trade would have played out really nicely, right? And obviously, if you were entering over here, that first target would have been over here in this area. But either way, first target hit, measured objective hit. So I hope all that makes sense. Let's wrap this video up though, talking about what happens when a pattern like this fails. And they do tend to fail, right? I think that, 10 years ago, because I've been trading for over 10 years ago, in most cases, these patterns would have played out, right? But now you get a lot of what are called fake outs or failed breakouts. So let's take a look here at another example. And we're just going to look at this here first before we get into the actual failed break. And you're going to see that we have a head and shoulders pattern that formed, right? And again, we've got multiple heads here. I mean, you could really make the case that this is kind of a rounded top up here, but it's still a valid head and shoulders, right? The shoulders are on the same horizontal plane. You have the head well above both shoulders. You've got this nice horizontal neckline through here. Now, if we move over, okay, first of all, you can see that this did confirm. It confirmed right here with multiple candles. Okay, and if we drag this level over, you can see that the neckline even served as new resistance. Okay, now if as time goes on, what you're going to see here is that the market actually broke back above this. So obviously, if you were trading this, you would have taken this as a loss. Now, in most cases, most traders will look at this and they would say, man, loss on this head and shoulders. They get frustrated and just say, okay, I'm going to move on, or I'm not going to trade head and shoulders anymore, etc. But they would be missing something, incredibly profitable in the markets. And that is when a pattern like this fails. When you get a really clean pattern like this, you get this uptrend here, you get left shoulder, head, right shoulder, clean breakdown, retest, everything. When this fails like this is the market telling you that this down here is a failed breakout for a reason. It's a failed breakout for a reason because you get liquidity that builds up below these lows. Liquidity down here, liquidity over here. Now, the reason you get this price action is because institutions are grabbing that liquidity that built up below these lows. They're grabbing that liquidity because they're filling buy orders. And so essentially, when you see this right here, when you see this close back above, what this is telling you is that institutions are on board. Institutions are longing this market because when you get a candle with this kind of velocity after a failed breakdown like this, again, this right here is institutions, guys. Institutions have filled their buy orders and are pushing the market higher. So ignoring that is not going to do you any favors. In fact, if we move over here, you can see where the market took off to the upside, right? This was an incredible move that lasted, for weeks, right? So the way you trade this is once you get this close back above, and this is a decision that you're going to have to make, do I trade a head and shoulders pattern or any pattern for that matter, or do I look for those failed breakouts? And for me personally, I actually love trading failed breakouts. It's kind of my number one strategy. In fact, if you're looking at the description of this video, you're going to find a free PDF there. It's an 8-page PDF that I show step by step, the 5 steps I use to trade fake outs like this. But that's a decision that you're going to have to make though throughout the course of your career as a trader. But once you see a candle like this, okay, it becomes very, very simple. You want to look for the market to come down here and test these lows. Now, you can see in this case, if this is our neckline down here, once the market broke back above, we never got a full retest of this level. And that's partly because, again, you have big buyers down here filling orders, okay? And you've got this momentum to the upside, right? So you're not always going to get a full retest of that level. However, if you look back here, right, and this is where, looking at key levels as areas instead of exact levels comes into play. Because if you look at these closing prices back here where our neckline is, what you'll notice is that this level technically, okay, looking at the closing prices back here, again, we're looking at this right here. Closing prices back here, closing prices back here. This level or this area is through here. And you can see that we did get a retest. Now, again, you may have missed this, okay, if you saw this in real time, just because we didn't get that full retest, and that's okay. But the point here is that failed breakdowns like this often trigger extended moves in the opposite direction. So you get this head and shoulders pattern that sets up, you get the breakdown down here, and then you get that extended move in the opposite direction. And I want you to remember that when you're trading any kind of pattern out there, if you get a failed breakdown or breakout, the market tends to move very aggressively in the opposite direction of the break. So that is, in a nutshell, guys, how you trade a failed breakdown like this. Now, as far as entry and stop loss and targets and all of that, obviously, like I said, you've got this area down here. We didn't get a full retest of that neckline, but if we had, or even if you would enter through here, your stop loss really would ideally want to go at least 2 candles back, maybe 3 candles back down here in this area. Because, again, if institutions are buying down here, right, and pushing the market higher, really, we shouldn't see the market coming back down here. Okay, now as far as targets, pretty straightforward here with a head and shoulders that broke down like this. You can see that we've got this area back here, right, that right shoulder and the head. So that becomes your target. You've got the target number 1 over here off of the right shoulder, and you've got target number 2 off of the head, which you can see we had this one hit right through here, and then we had this one hit right here as the market was pulling back, okay? So obviously we went quite a bit higher. This is a case too where you could leave half on or whatever you want to do in case we did get that push higher. But that's essentially what you want to do here. And if you're entering down here, right, and your stop loss is down in this area and your target's up here and up here, that's an incredible trade, guys. And this is, again, why I love trading failed breakouts. So be sure to grab that free PDF in the description of this video. All right, so that's it. I hope this video has helped open your eyes to head and shoulders patterns, the inverse head and shoulders, how to trade them, and also what to do when they fail. So be sure to keep it locked in here, subscribe to the channel, and click that bell icon for notifications. And also don't forget to grab your free PDF in the description.